right? But how do we measure return? You know, why do investment analysis at all? And the answer is to compare among investment alternatives. What do we buy? When we're in the commercial investment real estate world, we're not buying dirt, bricks, and sticks. We're buying expectations of future cash flow. How much do we pay for the future cash flow? Ideally, the present value of the anticipated future cash flows that we're going to get out of the property. That's what we're buying. You know, what is an investment? Who can define investment? Fundamental, and I'm not going to put Rory, Blake, and Margarita on the spot because they're required to know this, and if they forgot, they'll embarrass themselves, and I don't want to embarrass anybody. But how would you, yes sir?
A potential deposit that will yield higher than what you put in.
Thank you. Beautiful, elegant. Did everybody hear what he said? Put up money today because you expect to get more in the future. That's the classic economic definition of investment. All right, so let's talk about some measures. By the way, when investment real estate professionals get together, and let me say the subset of investment real estate professionals that are, let's say, doing institutional investing, you know, REITs, for example, that would own buildings like this, or the hotel that's down there, or a lot of stuff, well, that's education over there, but a lot of stuff you see on this side of the freeway. When those asset managers get together and they're talking about deals, are you buying? Are you selling? And then what's the next, you know, if you're buying or selling, what's the obvious next question?
Investing.
Investing, but if you are investing, if you're buying a property, you're selling a property, what's your next question?
Why?
No. You'll never ask why.
When?
Thank you. How much? How much?
How much are you making?
How much are you making? Yeah, how much am I? Well, that's the question. How much am I making if I'm buying, right? That's what counts. How much are you making if you're buying? All right? But the answer to that question is going to be a cap rate. The answer to, when you're in the investment world, the answer to that question is a cap rate. Does anybody know what a cap rate is?
Your return, right? 6%, let's say.
Could be 6%.
Very bottom after financing everything, but you figured out for
Okay.
that particular project, so it depends.
It depends.
I know why it's about
Well,
the
let me say it depends is the answer to, see, you guys are going to walk out with some useful information. So,
Everything depends.
everything is it depends. But when we're talking about price, if I have property for sale, if I'm running a REIT, let's say I'm running a REIT that only deals with marinas or hotels. Last time Rory and I saw each other, we were learning about that. The conversation is going to go like this. Are you selling? Yeah, we have some assets that we might want to dispose of at this time. At what price? And the answer is going to be a 4 cap, a 5 cap, a 6 cap. It's going to be cap rate. So this is one of the most important measures that you need to understand. Gross rent multipliers, most common in, I'm going to say properties that are traded more commonly, like Curtis mentioned, you know, the 8 to 10 unit. You're probably going to be talking gross rent multiplier. Cost per unit, also a good measure. So as the assets become more expensive, we become more concerned only about the cash flow metrics. Why? Because those assets are probably going to be owned by some financial institution, a REIT, or some giant real estate investment company. Investments that tend to be owned by private individuals, they tend to focus more on gross rent multiplier, cost per unit, cost per square foot. Cost per unit would be like how much per apartment unit, how much per cost per square foot. Let me ask you this. Think about the difference between these. Because when you leave today, I want you to know what these measures are. And by the way, I never get through a slide deck. So, that's why I asked Curtis and Diane and Blake to be sure you all had a copy. But you know, think about the value of cost per square foot. Let's consider a 6-unit apartment building, all right? And we're looking at the price per unit. Now, let's say the apartments are each, let's make them 750 feet. In 750 feet, we can have a fairly large one-bedroom apartment. We can have a fairly modest two-bedroom apartment. What do you think would have the higher cost per square foot in the same 107? The two-bedroom probably get more rent for that same 750 square feet than you would if the utility were only a one-bedroom. All right. So a couple points I want to stress here is when you're comparing these units, you want to compare similar properties. You want to consider the utility. You know, I have a buddy that owns a whole bunch. He probably has about 25 single-family and duplex homes that he owns for investment. And anytime I ever look at a property with him, he's walking through. He's not looking at additions. He's walking through and going, put a wall here, get another bedroom, put a wall here, get another bedroom. He's looking at improving the utility. All right. So that's how that goes. So, but let's talk about cap rate. And I really want to drive this home to you because it's such a fundamental measure. Cap rate is the ratio of the net operating income compared to the value of the price of the property. It's the ratio of the net operating income compared to what you put in, what you pay for property before taxes, before financing. All right? So if I tell you a cap rate's 5%, and the property is, let's going to say, sell for $10 million, how much net operating income would I expect to get? $500,000 a year. Now, to my way of thinking, if we're looking at a $10 million asset and we're all bidding for it, we are all in the market. Hopefully, if you've got $10 million to spend, you know what you're doing. And if you do know what you're doing, and I know what I'm doing, and you know what you're doing, and you know what you're doing, we should all come within a fairly narrow range when we construct the net operating income for that asset. So we're bidding, you know, what would we pay for that cash flow? How much would we pay for that cash flow that year number one is anticipated to be $500,000? Who gets to buy it? Whoever's willing to pay the most. Okay? So if that number says 500,000 and this number gets bigger and bigger, what's happening to the cap rate? It's going down. Let me say that again in a slightly different way. As the income's constant, so if the price is going up, the cap rate is going down. Okay? Vice versa. The answer is going to be the opposite. I'll just tell you. All right? So if the value is going down, the cap rate is going up. So when we see a market where cap rates are going down, that's telling us that investors are willing to pay more for cash flow than they were before. Why in the world would you do that? Okay. So we're leaving. We being professionals that we are, we've evaluated the property, we've reconstructed the net operating income, and among all of our investment companies, we agree within a very narrow range what the net operating income will be for this property. And we've established in an open and free market, whoever's willing to pay the most gets it. Well, as the price gets bid up, this number's getting bid up. The cap rate is being bid down. Does that answer your question? Okay, we comfortable with that? All right, so what are some things, now, so if cap rates are going down and we expect values are going up, the answers are very, very simple to this question. It's not a trick question, it's simple. What are some things that would influence value in a positive way? Why would somebody willing to be paid, why would you be willing to pay more?
Location,
Sorry?
Less inventory.
Less inventory.
expectation of higher
Easier to the money.
Wait, this is a really important one, excuse me. I'm wearing hearing aids, I have a really hard time with that.
expectation of a higher net operating income in the future.
Ah, thank you.
Potential.
Higher rent in the future. So, if we are in a property where we think rents will increase significantly, we pay more for that than if we think rents are going to be constant. And certainly, if we anticipate rent would go down. okay? Super important fundamental point, thank you. So if we have positive expectations for the market, shortage, supply, that also, scarcity, that drives up rents, increased anticipated rents in the future, we would pay more for that. And that's San Diego. That's San Diego where we see cap rates for apartments in the 4s. Not Norman, Oklahoma, where we see cap rates for 10 or 12.